Welcome back, everybody. At the end of this very long year, it's great to have you back with us. And also to be joined again by Alex Jamieson from AJFinancialPlanning, who we're still under lockdown restrictions to some degree, which means that we're talking online. Hopefully that will continue in 2021. Alex, welcome aboard.
Thanks, Greg. Great to be here. I've got a good feeling about next year. I definitely think we'll be in the studio, fingers crossed.
Well, one would hope so. Now, look, with lockdown, everything's easing now around the country. Do you have any thoughts about the economy and with the outlook for GDP growth?
Yeah, there's an insane amount of money that's being spent at the moment by the state governments and also by the federal governments as well. And in terms of context, it's actually they've spent almost twice the amount that they have in the GFC. So the GFC, they spent around 10% of GDP. This time around, they've thrown about 20% of GDP at it. So it's a huge amount of stimulus to sort of, I guess, get the outcome that they're hoping for. If we look at this number with GDP numbers, we're looking at the bottom set of numbers. So Q3 is this end of September quarter, and essentially at this stage, they're actually looking really positive. So this is the current forecast is 1.4%, which is looking, I guess, really positive. If we hit that number, now we won't know until December next month whether we hit that number, but if we do or anywhere close to it, technically the recession has ended. The government spent an insane amount of money to end it though too, so it's not without sort of a wash of capital behind it. And so I think at this stage we're fairly happy with things. With the US election behind us as well too, we think markets should be fairly a little less volatile, at least into Christmas, which will be nice to have a nice sort of, we call it the Santa Claus rally into Christmas. Hopefully we will turn up and continue as it's running at the moment.
Yeah, well, even with all that insane amount of spending, as you call it, it seems to me that we've been pretty lucky in Australia when it comes to recessions. I think the last one from memory was back in 1990. You can understand why some countries look at Australia as having a miracle economy when we've had 30 years without recession. Is there any key reason for that?
Yeah, a lot of people would automatically say, "Oh, it's China." All sending our mining products off to China and other parts of the world, and to a large degree, they would be right. I think the sleeper though, and probably the aspect that is one of the key drivers, is not often talked a lot. It's kind of, last time round we spoke about quantitative easing, how it really sort of favours growth-based assets. GDP growth is an interesting one. The politicians know exactly what is one of the big levers, and this slide shows that between 1% to 2% of GDP growth comes from our immigration policy. We're a big country, big land mass, and in global terms, tiny population base. There's plenty of places that they can put people, and so some of the spots you may not want to live, but certainly a huge amount of land mass, and so really, the governments have been keenly aware of the driving force of immigration. People moving into Australia, buying houses, spending more people spending more in the economy as well. It's really a gimme for them. They don't have to do anything for it. It's an easy sort of 1% of GDP that they can count on. Fortunately, during the COVID crisis, they declared everyone needed to return back to Australia. I can't help thinking that maybe that might have been that 1% GDP number they were hoping for. And certainly that's been a huge tailwind that's come as a direct result. With COVID next year, I guess we'll have to see. They won't have that big influx of the expats all racing back home. And certainly the normal sort of traditional overseas worker may not be able to get into Australia fairly easy in the first quarter, but certainly the back end. I'd say next time someone or you reflect on why we haven't had a recession, it's interesting, the GDP number, that immigration piece is a big part of it.
Okay, now, well, the dynamics elsewhere are probably not great for some countries.
Yeah, definitely that aging population base is a big one. And I sort of mentioned China just before, our big partner or contributor as part of that process. You can sort of see here a graph because of the one-child policy in particular has contributed this. The aging population in China is a real story, and And certainly it's, a lot of those aspects of Japan, in the 80s with a real, powerhouse sort of economy. I remember being at school and Japanese was sort of the language of business and the future being told. And today it's sort of Chinese is the language of business of the future. And so it's interesting how those sort of touch points are so very familiar. And, back in the 80s, large amounts of property was being bought up by Japanese companies through the East Coast, and China has sort of had a similar sort of relationship with property here in Australia too. So we sort of look more broadly at some of these other countries like the US, the UK, Germany and Japan. We can really sort of see that aging workforce sort of playing a big part of it. And that's really just that handbrake lever. We have it here in Australia, but we just sort of top it up with immigration. And so that's how we've sort of been able to bypass it. We can afford to keep, allowing people to come in and join us here in Australia. And that sort of swept that sort of issue over the table. Our replacement rate with new births isn't quite high enough to sort of replace us and add more people to the population base. So, yeah, the immigration piece has sort of allowed that to take place.
In our last update, we spoke a little about quantitative easing. I believe there have been some developments on this front with the RBA.
Yeah, certainly. We talked about quantitative easing and the effects that it was going to have with the economy, and really that was announced. $100 billion they've initiated. First time they've done that in history, which is really interesting, and dropping interest rates as well. I cast my eye over the term deposit rates, and you were lucky if you saw a 0.6 or less number being shown there. It was pretty ugly for those fixed interest sort of term deposit holders. What does that mean? Well, as we sort of said in the update, our expectation is it's just the cash register ring, ka-ching, ka-ching, for those growth-based assets. They're certainly going to, our view is, potentially inflate them over the next sort of year or two, in coming years, certainly into the future. And that's what we're seeing abroad, and we can't really see that being any different here locally. Really forces the hand for those fixed interest holders, and forces the hand for people to take on growth-based exposure, and then also just the wash of money inflating those assets too. So it'll be interesting to sort of see how that plays out from that standpoint. But at this stage, we're quite happy with what's taking place, and a little bit excited to see where these head.
Well, what's your view on the US election results, and its impact on the stock market?
It means I don't have to spend as much time on Twitter anymore with following Trump and his announcements, which is a nice thing. I think that political sort of landscape is going to become a lot easier, particularly the relationship and the executive orders with the uncertainty, unpredictability of that. That was really sort of allowing us to, I guess we were having to run so many scenarios with some of these decisions, and sort of makes it a lot easier. With Congress largely being gridlocked, it's unlikely Biden's going to be able to do much, similar to the Obama era as well. And really, he's probably not going to have a lot of appetite for huge executive orders as well too. The relationship with China, we expect, probably won't be as aggressive, and so that will ease the burden with the Australia being the piggy in the middle with a bunch of other countries as well. So we sort of expect some of those trade tensions to really simmer, and I guess return back to more of those diplomatic sort of channels that Obama was known for. Biden will likely follow a similar path. So make our life a lot easier, and certainly remove that unpredictability in the markets with that political piece, certainly as well. Not a lot will get done, which will allow businesses just to get on with making money and doing what they do. And so that will be positive for the business community too, both locally and overseas.
Yes, well, the presidency will change on the 20th of January. We've got a little time, but let's come back home with the COVID front. And I believe that's really an interesting dynamics when you look at this whole work from home or work from anywhere new reality.
Yeah, definitely. It's an interesting one at the moment, especially people moving to regional and coastal areas to sort of work from different locations. And I think we're sort of seeing reports in the newspapers with appreciations in some of those areas are really hot. Numbers between 20 to 50% property prices appreciation in some of these areas is really extraordinary, and very tight stock as well too. So I guess we've got question marks around the longevity of it, and whether longer term, whether this is a sustained trend or more of a short term sort of blip. Our view a little bit at this stage is we sort of feel it's more of a short term sort of reality. People are sort of talking about being in the office between 20 to 70% of the time, and certainly the commute's still going to be a problem if people are trying to have some footprint in the office, and if they're working completely remote, then obviously it's the issues around that re-employment sort of piece, getting that next job if they're not happy with their current work environment. That can be more challenging when possibly the new employers has an expectation of some permanent sort of footprint in the office of some level. The Bloomberg actually picked up on this piece, which was interesting, in this sort of pie chart, and they sort of found that over there in the US, certainly they were seeing trends where people that were working permanently from a distant location that was at a lower cost base, an employer sort of felt that they didn't quite have to pay them as much. So I guess that premium wasn't quite there for those staff. So it'll be interesting to see here in Australia whether a similar sort of dynamic sort of takes place. But at this stage, our expectation is those markets will probably likely cool off back end of next year.
Well, it seems to me that the world is in constant change.
That is so the case, yes.
So much happening. Look, let me ask you one last question. This is to do with the technology sector, which has been having a very good run this year. Do you see that continuing?
Yeah, like a few years ago, we sort of touched on that piece where the disruption of large businesses and their life stage. And I think, we sort of saw organizations at the time you would have never thought they'd be not there in 10, 30 years time, no longer being there. And I saw this piece in the Wall Street Journal looking at the S&P 500, and it was looking at the top 500 companies there, at the largest ones. And it, the first thing that kind of stood out was me just reflecting on that sort of piece that we did a few years back, and it's like, wow, this list is really quite extraordinary. It is such a big piece of technology companies now, whereas we looked at this sort of 10 years ago, you'd have mining companies in there, you'd have a lot of industrial companies in there, you may even have some pharmaceutical companies in there, a real mixture. And it's really interesting how that whole landscape has changed. Now, there still is some industrial companies in there with Berkshire, and some other sort of organizations, but it's it's almost like the gatekeeper has changed, and obviously COVID accelerated that. A lot of people sort of, there's this big sort of talk in the media about this great rotation out of tech now, tech sort of done into more traditional businesses, and we kind of sort of scratch our heads a little bit with that sort of comment. And it's like, why are you moving from a high growing area of the market to a low growing company that's ripe for disruption and poor outlooks? To me, it's sort of, I guess, struggle with that sort of, quandrum. We're not against diversification. We certainly have it in our clients' portfolio, that diversification piece, and different sectors, and obviously not just all tech as well. We think it's important, but we only sort of have to cast our eye and look at this piece. This is the online retail sales as a proportion of total retail sales. And you can sort of see the blip with COVID, which is huge, but it's still below 20%, which is such a small number. I would have thought this, actually be a bit higher than this. But in terms of our view, where do we see it heading? At least sort of 50 to 70% of total retail sales. I wouldn't be at all surprised at some point in time in the next decade we get up to that sort of 50 to 70% sort of level. And going out and shopping is more of an experience thing. It's like going to the movies type of idea. It's something that you want to do and you enjoy to do, rather than you begrudgingly going to do something. So yeah, it's an interesting piece. We still see there's a long runway ahead. And, when we sort of look at China as well, with their retail sales online, it's about 30%. I guess they're sort of leading the charge in that space a little bit too.
Well, it sounds as though you're going to have plenty to work on in 2021. And I've got to say, I'd rather look forward than back over this past year, particularly for those of us in Melbourne. Not been the greatest. In saying that, it's been great to be with you through the year. All the best to you, Susie and the boys, over Christmas, and I hope you can get away and have a bit of a relax. Anything you want to say? Any messages that you want to leave on a more general notice?
Yeah, It's been an interesting year, that's for sure, Greg. I'm hopeful we won't see a repeat of that. I'm fairly confident that we won't, that's for sure. But yeah, certainly, I think it was great that we could sort of get together and do some of those updates, and I guess made some pretty bold calls at certain sort of points with myself and our team that we did over this period of time. So we're quite pleased with how those sort of bold calls sort of came to be. I guess played out, and I guess a lot within our expectations, which was fantastic. But yeah, hopefully next year we've got a more quieter year, something that's a little sleepier, that's a bit easier, nothing like this one. It would be nice, and yeah, definitely ready for a well-deserved rest. And I think I'll spend at least a week doing some sleeping and some catch up on some sleep.
Good on you, mate. Well, let's leave with a quote that is looking at next year. Now, this is from Sarah Barnett, and she is a best-selling author and philanthropist. She was born in New York, I think lives outside Billy's these days, in her 70s, and she writes, New Year's Day, a fresh start, a new chapter in life waiting to be written, new questions to be asked, embraced and loved, answers to be discovered and then lived in this transformative year of delight and self-discovery. Today, carve out a quiet interlude for yourself in which to dream, pen in hand. Only dreams give birth to change. Now, I think Sarah Barnett must be very much an optimist when she says this transformative year of delight and self-discovery. But it's nice to look at it this way. So I would ask you, watching today, to consider taking a small amount of time for you to think about what dream you would like to achieve in 2021, and then have the courage to write it down, get a pen, write it down on paper, and then see what small changes you can make towards making that a reality. That's it from me. I hope to catch up with you in the new year. In the meantime, happy investing, think well, catch you next time.
The advice provided on this program is general advice only. It has been prepared without taking into account your objectives, financial situation, or needs. So before acting on this advice, you should consider the appropriateness of the advice and consult a finance professional. If any products are detailed on this program, you should obtain a product disclosure statement relating to the products and consider its contents before making any decisions. Where quoted, past performance is not indicative of future performance.